Ready for a recap of 2021 and for market predictions of 2022? Well, let's go. Hey everyone, it's Alyson with Live South Denver, your real estate strategist and realtor for the South Denver area. Here is Denver by the numbers for the last month of 2021. Buyers put 3,150 homes under contract in December. This was down 3% from last year, but up 2% from 2 years ago. We had 4,400 closings last month, but that was up from 2019 by 3%. New listings were down 13% to 2,500. This was still an increase over 2019 though. We ended the year with only 1,400 properties for sale. That gave us less than 10 days of available inventory and gave us a tie for record low days of inventory with March of 2021. The average days on market for December was 17. This was up 6 days from the month before, and for some perspective, back in 2019, the average days on market was 40. The median days on market, however, held steady at 5. As you know, we spent most of the year around 4 to 5 days on market as our median. The average list price to sold price ratio for the month was at 100.8%, and the average price for all homes was $620,000. That's up 17% from last year and up 31% from 2 years ago. The average price for condos and townhomes hit $438,000, up 18% from 2 years ago. And the single family home price in December hit $700,000, up 35% over the same 2-year period. Median sold prices always sound much more attractive. The overall median price in Denver was only $540,000. It's still up 19% from a year ago and up 30% from 2 years before. The median price on a single family home is almost at $600,000. We're right at $595,000, up 19% from last year and up 35% from 2 years ago. And for those townhomes and condos, the median price is at $380,000 as of the end of 2021, an increase of 15% from last year and up 25% from 2 years ago. When we look at 2021 on the whole, Denverites listed 63,000 homes for sale, but this is down 7% from the year before. That number sounds huge. It was, but it wasn't record-setting. In fact, it's the fewest number of homes listed for sale since 2017. On the flip side, buyers bought 60,000 homes and did set a record. That's the most homes ever sold in a year, and it's a 2% increase from 2020. With that 9% gap, 7% fewer listings and 2% more homes put under contract compared to 2020, we saw an average list price to sales price ratio across the whole year of 102.6%, never seen before. Another record. We've never had the average list price to sales price ratio top out over 100% in a year. As we talked about before, that number speaks to the bidding wars. It speaks to how aggressive a market is, and last year was one for the record books, to say the least. We ended the year on a high note, telling us that we are launching into 2022 aggressively. We're going to talk about that in a minute. December's median home price of $540,000 matched the high median home price of 2021 that we hit in June. I reported on it in July. Matching a high price for the year at the end of the year is definitely an anomaly. This does not happen very often. Don't know if we've ever seen it before. It tells us that while we had that lull in the fall that I've talked about, buyers are ramping back up, coming hardcore and full court press into 2022. I saw that. I talked about it in the last market update, but that was kind of my microcosm, boots on the ground feel. The data supports it, and it is a real thing. The Boulder fires happened at the end of December, and people are asking a lot about what that means for the real estate market heading into 2022. So it makes a really good transition into my predictions for the 2022 market. I think the big impact right now is on the rental market. Rental market's already very tight. We've seen 17% increases in rent over the last year. We see vacancy rates in and around 4% across the Denver metro area, and the towns that were affected by the the fire were already small towns with not a lot of excess inventory. Well, nowhere in Denver has excess inventory, but they really were lacking. So they don't have much opportunity to absorb these families. So the families are having to go a little farther outside their area to figure out housing. These families are getting temporary housing. It may not be short-term, it's probably midterm to long-term housing, but it is temporary as they work through insurance and figure out next steps. They're not jumping in and buying a house right now. They have no funds with which to do that. At least most of them, I'm guessing, do not. So the impact on real estate is not immediate. It's more rental. So what is it going to mean for the real estate market? That's a longer term play. These neighborhoods are probably going to see a dip in value, as are the immediately surrounding neighborhoods. One, from perception of risk. Two, from burn scar. People are going to want to see some rejuvenation, some greening up, some restoration of landscape and appearance. The other is just, it's people who aren't rebuilding are going to have a hard time getting someone else to take over their land. And then those who are rebuilding are going to need time. There's a lot to get through. So I think it's going to be long and protracted, but they'll recover. We've seen before with floods and other things in and around the Front Range, generally about a 2-year time frame. So we'll be able to look back and see it, but I don't think it's going to be a hard press on the market from north to south Denver that people are going to feel. The other factors that we're going to talk about are going to continue, and that's what's going to be our concerns. Let me share some good news about the market, and that is that conventional loan limits have increased dramatically. I am so happy about this. With the average single-family home price hovering around $700,000 right now, conventional loan limits have increased to $684,250 for nearly every county in the Denver metro area. This means if you're a buyer that can bring around 10% down, you're going to be able to get a home around $750,000, which is above the current average single-family home price. By summer, we'll probably be near $750,000 for average home price. So that gives you room to have time to play in the market. It's a great number. Love it. And for those of you that are not looking to go that high in home prices, it gives you some room to navigate those bidding wars that seem to be the norm these days. And the bidding wars actually have been around well before we got into COVID years. They became commonplace in Denver back in 2013. The market was really ramping up around that time frame. We bought our new construction home in 2014. We went under contract a little bit before that. We wanted something new, didn't want to put the effort in. We're not handy people. I'll do some crafty work, but we aren't going to put the effort in to remodel a home. The median days on market in 2013, when we saw bidding wars ramp up, was 17 days on market. The median days on market through most of 2021 was 4 to 5 days on market, drastically less. This speaks to the intensity of the buyer demand and why we see the bidding wars the way we do. For a reference point, back in 2012, the year before bidding wars kicked in so intensely, the median days on market was 31. We're talking a 6 to 8 multiple of where we are today. So until we see that buyer demand soften relative to the inventory we have, expect that you're going to be navigating a bidding war if you're a buyer. Sellers, expect to be in a strong position, but please do not overprice your home. Buyers are not going to overbid on an overpriced home, so you will lose. Now, when I talk about bidding wars and market intensity, the conversations on the one-on-ones that I do ramp up around new construction. Buyers think new construction is going to be the way to go. It decreases my stress. I avoid bidding wars. Tell me all about it. Open up all the doors. And you all know I specialize in new construction. A third to a half of what I did this year with clients was new construction, and it's a great option. However, there are challenges. Many of the builders have oversold their lots into next year and see themselves slowing their pace. In December, I got notice from a particular builder in a community. They were doing a $50,000 price increase. Many of the builders have stopped building from dirt and are doing all spec production. So for those of you who really want to control the lot you get, the model you get, and every bit of the details, not just the design selection, the structural components, being able to match up which direction your driveway is going to face with the lot, with the walkout component, all of those things together, the choices of builder are really diminishing for you. And the ones that are allowing you to start from dirt are at a much higher price point for the most part. The waiting lines for builders has really grown. There are just a few that are delivering spec homes consistently, which shortens up the wait time if you can get in and you know when they're going to deliver those notices. And that piece of the puzzle is adding a layer of stress for buyers. So on one hand, in the existing home market, we have the bidding war stress. And on the other hand, in the new construction market, we have the waiting line stress. Because as you wait with the builder, they're doing regular price increases. Typically, it's every month. Maybe they do it with every lot release if they are releasing lots on a different pattern. But if you're in line and you don't know how long it's going to be till you're next, you're just watching the price increase. And that's before you've gotten to adding on your selections and opportunities. So really, in this low inventory, high demand market, neither option is low stress. And we have to weigh through your individual situation and understand your budget, your time frame, your needs, and then we can move forward with a great choice. The supply chain issues for the builders is a real thing. 1 month it could be garage doors. Right now it's windows. It has been plumbing. I have had clients who have these deluxe tubs coming out of Europe sitting in their houses without the plumbing to hook them up. Tubs sitting in garages and people aren't able to park in their garages and the cars are sitting outside. I had folks who got garage doors literally hours before closing. So their house was only going to be secured by their doors, no place to kind of put all their items as the movers were bringing them in case they didn't have a place to put them when they unpacked. It is a real issue. Sections of countertops not coming in, drawer faces not coming in, lots of concerns. And so if you don't have a tolerance and some stretch in your life for things like that to happen, that's another reason why an existing home really may be the route you'll want to go, because these builders just don't have the ability to force and shoehorn in all these pieces to happen. And the municipalities that used to not give a CO or certificate of occupancy until the house was completely done have begun to bend in understanding the way business has to work, and the builders have to close a certain number of homes at a certain time to keep moving forward. And they will give a CO with a house that's not fully complete. It'll need to be secure, but it doesn't need to be complete anymore. And that adds to frustration and tension. And so there is another piece of the puzzle to think about, because we don't know how long it's going to be before all of our collective countries and companies that manage our supply chain are going to adapt to what has become a new normal for them and maybe get this under control, whatever that looks like. I have not forgotten about the other big player on the scene. It is not just buyers, sellers, high demand, and low inventory. It is money. This year in 2022, it is going to be mortgages, mortgage rates, fiscal policy, inflation. That is going to be a player on the scene we really have not dealt with over the last couple of years. Interest rates are expected to increase. We're already starting to see a little bit of creep. Nothing that has played into it enough that I have had people back away, not show interest. In fact, I think what's happening is people are pressing in. It has really been a full court press, hardcore. So many people showing interest and immediate, rapid, fast-paced buy now interest in the market. I think that's going to continue through Q1 and Q2 of this coming year. And then as interest rates, if they do go on the trajectory people are thinking and get closer to 4 as we crest through summer and into fall, then we may see a slowdown and a pullback in the market at that point. Most lenders that I'm talking to are saying interest rates won't go above 4 this year. They, like me, don't have crystal balls. It's just their experience, their gut reactions. Also, if interest rates do not go above 4, I don't think it's going to have any impact on our market at all. Those are historically low rates. We've just been blessed with rates that are even lower. 4 is amazing, and people should snatch that up while they can, because if rates are going to go higher in the coming years, people will regret they didn't take 4 when they had it. All right, what do all the big prognosticators say about home price increases on a national level? Well, Zillow predicts home price growth nationally of 11%. Fannie and Freddie say it's going to be 7%. Redfin and Realtor.com both come in at just 3%. Wow, I cannot imagine that given what I see here in the Denver market. CoreLogic says 2.5%, and the Mortgage Bankers Association says that home prices are going to decrease 2.5%. I think they're way off base, but we'll all get to see at the end of the year. Now, here locally for the Denver market, Zillow says that the Denver market is going to increase in home prices, 18%. And Realtor.com says we'll see an increase of 5% in home prices. My opinion, a minimum increase of at least 10% in home prices. Not trying to just split the difference. That number is partly in hopeful anticipation that the market does not mirror this year. I do think the first half of the year is going to mirror 2021 with rocket-like trajectory, but I do think there's some hope that things will slow down in the last half of the year. I think we'll be at 10 at least. I don't know if we'll hit 18% like Zillow says, because we were at 19 for this year, and I'm not sure we'll be exactly on the same pace. So there you go. We will see at the end of the year if I came remotely close to being right. If you have any thoughts, comments, questions, please leave a comment below or reach out. I would love to connect with you. You can call, text, or email, and I will see y'all next week.